Harami candlestick pattern. The word harami, that means pregnant in Japanese, is a multiple candlestick pattern. It is considered a reversal pattern. Harami is a two-candle pattern. The first candle is usually long and the second candle has a small body. The second candle is generally opposite in color to the first one. The first candlestick is referred to as the mother, with a large real body that engulfs or embodies the smaller second candlestick, and thus creating a visual of a pregnant mother. Harami candlestick pattern is the opposite of engulfing pattern, except that the candlesticks in the harami can be of the same color. On the appearance of harami pattern, a trend reversal is possible. Now again, we have two types of harami patterns. One is the bullish harami and the second one is the bearish harami. Let's have a look at bullish harami candlestick pattern. Bullish harami is a bullish pattern appearing at the bottom of the chart or at the end of a downtrend. The bullish harami pattern evolves over a 2-day period similar to the engulfing pattern. A bullish harami candlestick is formed when a large bearish red candle appears on day 1 and it is followed by a smaller bullish candle on the next day. One should note that the important aspect of the bullish harami is that the prices should gap up on the second day. Now, how do I trade using bullish harami pattern? The idea is to go long on the bullish harami formation. Aggressive traders can initiate a long trade around the close of the second candle. Additionally, aggressive traders should validate couple of conditions before entering a trade using this candlestick pattern. First one, the opening of second candle should be higher than the close of first. The current market price of second candle during previous day's close should be less than the first candle's opening price. If both these conditions are satisfied, we can conclude that chart shows a bullish harami pattern. Safe traders can initiate a long trade at the close of the day after second candle completely forms. In other words, safe traders can enter only after confirming that the second day is forming a green candle. Now, if I have to talk about the stop loss, then the lower wick of these two candles, whichever is on the lower side, will be my stop loss for a particular trade. Next is the bearish harami. The bearish harami pattern appears at the top end of an uptrend, allowing trader to initiate a short selling trade. A bearish harami candlestick is formed when there is a large bullish candle on day 1 and it is followed by a smaller bearish candle on day 2. One should note that the important aspect of the bearish harami candlestick is that the prices, they gapped down on second day and they were unable to move higher back to the close of day 1. Now, trading with bearish harami pattern. How do I trade using this particular candlestick pattern? So the idea would be to short sell. That is, if I am an aggressive trader, I can initiate or I can short the market near the close of second candle after ensuring that a bearish harami is being formed. Now again, we have to validate few conditions to ensure that the pattern is indeed a bearish harami pattern. First one, the open price of second candle should be lower than the close price of first in bearish harami formation. The close price of second candle should be greater than the open price of first candle. Safe trader will short the market the day after the second candle after he has ensured that it is indeed forming a red candle. The highest high between these two candles will act as the stop loss for this particular trade. So that's all about bearish and bullish Harami candlestick and trading with these two candlestick patterns.